Hello everybody and welcome to the Like a Tortoise channel. Happy Thursday to all of you dear viewers. In today's video I will be delving deeper into 5 stocks you, ladies and gentlemen, asked me to analyze over the past few weeks, okay? I never forget about your suggestions and I make sure that I always write them down. But then of course I cannot cover them. There are only so many names that I can cover due to time constraints, but whenever I can, this is what I do, and hopefully you will find a lot of value in today's video as well. If you like it, please make sure that you smash the like button, because it does take a lot of time to actually pull together all the data from different sources, but hopefully I want to make your days easier by doing so. Okay, everybody, so let's talk about these 5 stocks. Right now I'm recording this on April the 9th, and you can see right here that the markets are breathing right after a significant decline. Yesterday we saw a huge rally. I think the Nasdaq was up almost 4% at some point, at one point. Yeah, look at that. I mean, this is incredible, right? From the current lows. Now, is the bottom in? I have no idea. I'm not a forecaster, as you guys know. But what I do know is that because I was adding to some of my positions in the whole, now they are trading nicely in the money, and this is exactly what I mean. So if you guys have the patience and if you have the conviction that you've made the right investments, then at the times of despair, that's exactly when you should be bringing your cost basis down, and that will for sure guarantee market beating returns down the line. And the investors that actually have the guts to do that should be rewarded, of course. And that's all we are here for, to be rewarded by making sound investment decisions. Okay, everyone. So the 5 stocks that I want to cover today, they are the following. Da-da-da-da. Stock number 1 is Constellation Software. And I will tell you, so you guys asked me to analyze Constellation Software. I told you before that I had already created a video on Constellation Software. It was probably my most complete video on a single company up until now. It was a deep dive on this company and why I've decided to make it, why it deserved to earn a place in my portfolio. But here are the main takeaways. Okay, so, and by the way, we will always analyze any company through our 4M's, to our 4M framework, and that includes meaning, moat, management, and margin of safety. Right here, you can see that we are only covering in this document the 3M framework, but we will talk about valuation as well at the end of every analysis. Right, so Constellation Software, and you guys even asked me to compare Constellation Software with, what's the name of the company? VTech Software, both of which are in Sweden. Okay, so let's do that. Right off the bat, everybody, what you can see right here is that unlike Constellation Software, which boasts a narrow moat according to Morningstar, this one right here, right, so VTech Software doesn't have any moat whatsoever. Morningstar doesn't assign a moat to the company. This is a bit of, is this reason enough for me to exclude the company? Because I always follow my framework to the teeth. So the Like a Tortoise framework, what happens is never, ever in my experience as an investor so far, if I delve deeper into a company that I was interested in, that met my quality criteria, that didn't have a moat. And it makes a lot of sense, right? Because when you are applying the framework, you are looking for quality. And quality means that the company needs to check several boxes in terms of profitability, returns on capital, and like management having skin in the game, all of this stuff, all of these things that I've already covered at length. And for the company to do that, especially if you are looking at data over the past 5 years, right, the company needs to have a moat, right? It's just, and so, yeah, every single company that I've ever been interested in, that I've added to the watch lists over the years, they always had a moat. It can be a wide or a narrow moat, but they always had a moat. So I'm pretty sure that VITEC or VTEC, whatever you call that, I don't know how to pronounce it, sorry for that, but this will probably fail to meet our criteria. But we will delve a bit more into this company later on. Let's start with Constellation Software. So, meaning, do I understand the business model? How exactly do they make money? As you can see, they acquire and operate niche vertical market software businesses. They focus on mission critical software with high recurring revenues. Decentralized structure allows subsidiaries to operate independently. There are so many things going for this company. And, I'm so happy that Manish Pobrai actually decided to make it one of his portfolio positions. And that was completely unexpected. Because if you guys follow someone like Manish Pobrai, you know that his investments are low. I mean, maybe he could make. Look, I mean, for let's just keep it simple. I don't think they are good businesses whatsoever. Many of them can trade at PEs of 3 to 4 times earnings, but that's why he's a core value investor, and I'm not a core value investor at all because I like to guarantee quality first, and so I was very surprised to see that he had added Constellation software to his portfolio. And, it just serves as reassurance. It's a confirmation because he bought after me. But yeah, okay, so cool. So many things going for this company. I really love it. And it has one of the best compensation packages that I've ever seen. Like the structure, how the business is working and rewards both shareholders and the management team is just staggering. So, yeah, moat narrow according to Morningstar. They have high switching costs. Customer rely heavily on software, very difficult to switch, very difficult. And they also provide, as I mentioned here above, mission critical software. They cannot. So if the software stops working, the business in its entirety stop functioning. They cannot allow that to happen. Sticky recovering revenue base, mostly because of maintenance, right? Once they install the software, ongoing maintenance is required, and that's where the recurring revenue comes from. Fragmented market creates continuous acquisition opportunities, especially now with software companies under significant strain. Chances are they will continue to find attractive opportunities. Exceptional capital allocators, long track record of value creation, founder-led culture. Mark Leonard, who still sits on the board of directors, even though he stepped down from the big role as a CEO due to health issues. With strong discipline, focus on ROIs and long-term compounding, not short-term optics. Every investment decision they make is with the shareholders' interest at heart. Okay, now let's have a look at VITEC Software, meaning acquires and manages niche software companies similar to Constellation, focus on long-term ownership in decentralized operations as well, exposure to multiple small vertical markets, no moat according to Morningstar. They do have some switching costs at subsidiary level. However, overall group lacks durable group-wide advantage. Smaller scale versus peers limits competitive strength. Management, strong M&A-driven growth strategy, long-term mindset similar to Constellation Software, which is very good, execution dependent on continued acquisition success. I'm going to show you something right here that I also did for today's video, and let's compare both these companies. Boom, voila. Let me just minimize this. I want to make sure that you get as much value as possible. So here we go. Look at that. I just extracted that from stock analysis, and the goal here is to compare them across several metrics. So you can see, focus on that software application. So we have Constellation Software and VITEC Software. You can see how they score on ROIs over the past 5 years. The ROI over the last 5 years. I mean, look at this. This is absolutely incredible. So the average ROIs for Constellation Software over the last 5 years sits at about 19.34%. And look how that compares with only 8.75% for VITEC technology. That is a sharp difference. And you guys do know that ROIs is the most important metric in my world. Okay, So I love seeing that. And the same happens with trailing 12-month ROIs. This is staggering. Big, huge difference. Now, VITEC has a slightly higher, has a higher gross margin, as you can see. They score higher. They have a higher operating margin and they have a higher profit margin. I don't pay too much attention to that because it's the free cash flow margin that matters, right? These guys do a lot of acquisitions that creates amortization costs, which cause profitability which understates the earning power of the company because profitability is lower relative to free cash flows. All right. So debita, debt as a percent relative to EBITDA, 2.2, 2.7. Debt relative to free cash flow, you can see that Constellation Software has lower debt relative to free cash flow. This is what I want. And so that's it. Revenue growth over the past 5 years, you can see that Constellation has grown revenues at almost 24% versus 19% for VITEC. Earnings per share, again, this does not reflect Constellation Software earning power because of what I just discussed. And that's why metrics like the PE and PE 5 years don't really matter. Okay. But if you look at the free cash flow yield, unfortunately, is it here? Yeah, look. So the free cash flow yield for Constellation is 7.14 and for VITEC is 10.76. Certainly in the case of Constellation, this is practically at all-time highs, which is staggering because the company had never traded as cheap as they trade today. Okay, look at the price to operating cash flow. All right, guys. So hopefully, yes, I definitely prefer Constellation Software every single day, but you can see how they compare across these metrics. Okay, now let's have a look at the other companies you guys suggested, and that is, and for that we will now move on to, let's move on to the pack. So we have, yes, let's do Deckers Outdoor. Right, so you also asked me to analyze Deckers. In this company, I had the opportunity to analyze them when I was making up my mind as to whether invest in a company like Lululemon or Deckers. I just settled for Lululemon, of course. But Deckers has fabulous fundamentals, and we will look into that Excel file in a bit. But let's cover them. Let's look at the company through our meaning, moat, and management lens. Meaning footwear and apparel company, right? Growth increasingly driven by Hoka performance footwear. Here in London, I see so many people walking with these shoes. It's just unbelievable, and I think they are so ugly. I mean, but that's just my take. I'm sorry about that. If you guys are fans of this, I just think like the format is horrible, in my opinion. But anyway, strong direct to consumer expansion, improving margins. Okay, we like that. So they sell directly to consumer instead of using wholesalers as third parties, which is why this bodes very well for the company. And this is similar to what Lululemon does because it avoids brand dilution as well. Moat is narrow according to Morningstar, yet they do have a moat. Brand strength, UGG legacy plus Hoka growth. Pricing power in premium categories, however, fashion risk and competition limit durability. Management, strong execution in brand building and channel shifts, effective inventory and cost management, proven ability to scale Hoka into a global brand. So if I show you right here the Excel file, and if we go to the footwear category, which is right here, footwear and accessories industry, where they operate in, of course, you can see that they scored the highest on a ROIS basis. Yes, because ROIS is my important metric, and in all of this is all of these columns that you can see right here are filtered by ROIS, okay, in descending order from largest to smallest, and you can see how Deckers has the highest ROIS by far relative to any other of its competitors. Okay, this is incredible. ROIS of 87.67%. What the heck is happening here? I mean, is this an outlier? So this is something that I would have to delve deeper into. However, guys, take a look at this. Royce over the last 5 years, 70.29%. This is incredible. This means that these guys are very efficient when it comes to investing capital. So they can turn net operating profits after cash. I mean, what's the best way to explain, Royce? You calculate it using the NOPAT divided by invested capital. So it means that they are very profitable, right? Because they convert a lot of that invested capital into net profits after tax. And this is why ROI stands at about 70.29%, which is staggering. So, I mean, for comparison, if you look at Nike, right? I mean, take a look at this. Nike's 5-year ROI sits at 37.23, and right now it's at 14.16%. By the way, this company is getting absolutely hammered, and many of the things that are happening with Nike are exactly why I decided not to invest in the company. Okay, I saw a shrinking business that I mean, even though they have a wide moat, that doesn't mean the company cannot go even lower. And I think the problems that they are facing are a lot more significant than the problems that a Lululemon, for example, is facing. So yes, look, very, very good. And now look at the gross margins, 57.54%. This is all pretty stellar. Operating margin, 23.90%, the highest operating margins across this industry. You can see that only one company right here at 25.90%, and that is this company I've never heard of. They have gross operating margin higher, but then look at the operating margin at 19.35%. That compares to just 4.84% for Nike. That is incredible, right? I mean, incredible. And in addition to that, not only are they far better capital allocators and boost far better profitability metrics, but they also have far lower debt levels compared to Nike. Now, look at that. Debt to EBITDA is only 0.23, Nike 22.24, debt to free cash flow 0.37, Nike 10.67. Nike is doing a lot of reinvestments, which is depleting free cash flows, right? So a lot of this is self-inflicted, but still, you guys know me. This is too leverage for me, for my liking, because I like to invest in companies with debt to free cash flows under 3. The interest coverage, yeah, I mean, this is incredible. Let's just put it that way. And look at the projections. So according to analysts, revenue is expected to grow at about 9% going forward, versus 4.15% for Nike, and earnings per share growth for the next 5 years stands at about 11%. In the case of Nike, that is 18.37%, which is staggering. Remains to be seen whether the company will be able to deliver that. But then this is what it's fascinating. This is what is fascinating. Because I do not believe Nike is trading at these multiples. Nike does not deserve to be trading at these multiples. Now look, either Nike's multiples are going to plummet, right? If they don't manage to justify those valuations, and in my opinion, they are not being able to justify this premium. It's crazy, especially when you compare it with businesses that are far better from a quality standpoint, like Deckers. The only reason Nike is still has a premium is because they have a wide moat. But again, that means the business is still declining, so not good to see. Either they multiples come down, or Deckers multiples go sharply higher, in which case an investor in Deckers could make a lot of money. But so very low. And look at the price to operating cash flow as well. Very, very interesting. But yeah, so these are very, very interesting things to see. The free cash flow yield sits at 6.15%. In addition, take a look at this. Analysts rated a buy. Same thing for Nike, but the business is far better quality. And now here I also highlighted you have Crocs. Crocs is a company that famous investors have also invested in. I just, not for me. Let's just put it that way. I just highlighted it right here because it's a stock that is discussed at length. But yeah, and then I use Nike to compare it with Deckers because Nike is, of course, the biggest. They still have the largest market share, right? So they have the biggest market share in the space. So is Deckers an attractive company at today's levels? Yes, from a quality and valuation standpoint, at least on a relative basis, but you have to understand the moat, okay? Because these metrics, especially the consistency over time, tell me that they have a moat. But before investing in them, make sure you understand exactly what the moat is and what will cause the moat to be intact in the next 5 to 10 years. Okay, so I hope that was helpful. And now we will go into the packaged foods industry because some of you guys asked me to analyze companies in that space, one of which is the Campbell's company, meaning packaged food company, snacks plus meals. Portfolio includes well-known household brands, demand driven by stable consumption and convenience. Moat is wide. The only company out of these 5 companies that I'm discussing today, the Campbell's company is the only one with a wide moat according to Morningstar. Strong brand equity across multiple categories, scale advantages in distribution and shelf space, resilient demand for consumer staples. That is their sector, right? So the industry is packaged foods, but the sector is consumer staples. And resilient demand, management focus on cost control and margin improvement, active portfolio reshaping, capital allocation more balanced, dividends plus reinvestments. So all of that, and now let's compare that with General Mills, meaning global consumer staples company. Of course, categories include cereal, snacks, pet food, stable recurring demand profile. Moat is narrow, according to Morningstar. They house strong brands. Cheerios, we all know Cheerios. I don't know how to pronounce this name. Hagen Dazs, etc. Scale and distribution advantages. Private label competition limits moat strength. Management, consistent capital return, which includes dividends plus buybacks. Focus on operational efficiency. Moderate growth strategy with emphasis on stability. Now, if we go here to our Excel sheet that I pulled out from stock analysis, you can see that this is where they are. Let me highlight this in yellow for you, and you can see that, right? So look, the ROIs of them is very similar, as you can see, but then very similar, but then General Mills has a higher ROI. That can be because of leverage, in other words, because of debt, which can boost ROI. So take that into account. But ROIs over the past 5 years is around 11.86 for the first one and 12.51 for the second one. So ROIs is very consistent over time. I like to see that. Same thing with ROI. In terms of gross margins, you can see that General Mills is has better gross margins. They also have far better profitability. Look at that. So the profit margin is 12.05 against 5% for the Campbell's company. And now, there you go. The debt to free cash flow in both these cases is quite high. I don't really like to see that, as you guys know. I like less leverage balance sheets. Because this means that it will take the company 8 years of free cash flow to pay down all of its debt. Maybe they are doing a lot of reinvestments. Make sure you understand that, in which case free cash flows will be lower than typical. However, even with that, I don't like to see this, okay? Don't really like that. In the interest coverage ratio, I typically like to see this at or above 8, right? I don't really like to see that. The interest coverage ratio, for those of you guys who are new to the channel, it tells you how well the company can meet the interest payments on the debt from operating profits. And so don't really like to see that. Typically, I like to see double that, okay? Yeah, and this is part of the reason why these staple companies don't really meet my criteria for quality. I mean, take a look at this nonsense. Revenue growth over the past 5 years is even negative for General Mills. I don't like that. I like to see companies growing revenue, say, at 9-10%. That is ideal. Definitely not the case for this business. And look at the revenue growth projected for the next 5 years in these two cases. What? Yeah, definitely. I don't like that. Okay. Never mind the low PE, because if I don't have the quality that I demand for every one of my investments, I don't care how cheap the company might look like, because it just doesn't meet the first half of my criteria. Yeah. Okay. Yeah, criteria. I don't like this. In addition, analysts don't seem to like it either, because they have a hold rating on both these companies. I highlighted another ones, for example, Herbalife. Analysts rated a strong buy, as you can see right here, and the fundamentals seem to be more attractive, at least, but not very good. Not very good. I know quality investors who have bought into Hormel Foods. And Buffett himself invested in the Kraft Heinz company not that long ago, but now he's stepping down. And the guys that are taking over from him have already sold part, if not every, position that they held in the company. So yeah, I just make sure that you understand these businesses if you are invested in it. But you can see that while analysts rate Kraft Heinz a hold, they rate the other two that I just discussed a buy and a strong buy in the case of J&J Snack Foods Corporation. Okay, some interesting names that you might be considering analyzing. So this is it, guys. What else did I wanted to share? Now let's have a look. To wrap up this video, let's have a look at what insiders are doing, starting right here with our VTech company. If I go to the insider tab, you can see that insiders have been buying the stock hand over fist. I like to see that as well. Okay. In addition, you can see that insider ownership is very, very high. So I like to see that. There are many reasons why they would sell, only one reason why they would buy. So this is very good to see. That said, I would stay away from it. Now let's have a look at the other one, like Constellation Software, which we also discussed. Constellation Software. Here is the insiders, also high insider ownership. You can see that insiders have also been buying, which is very, very good. What's this here? Huh. Okay. I didn't know this. Someone was buying shares recently, ladies and gentlemen. So we have this guy, Bender, Jeffrey James, Simons, Barry Allen, and Pastor. These guys have been busy buying more shares. Huh. Very good to see. Okay. Very, very good to see. Very good. Let's talk about the Campbell's company. Campbell's company. See what insiders have been doing. You can see that I see selling, not a lot of it, but I do see selling, and I don't see any buying. Let's let's leave it at that. Okay, nothing exciting. And the other company is General Mills. General Mills right here. Let's see what they have been up to. Yeah, I see some selling right here. I don't see any buying, so nothing exciting either. So I think if we covered all of them, we covered Vitech, we've covered General Mills, the Campbell's company, Deckers. Let's see what Deckers insiders have been doing. Nothing really. So you see this is a sell, but this is nothing really. I see some selling right here that was happening at the beginning. So in February 2026. So they were selling. There was a lot of selling right here, as you guys can see. But I'm not seeing any buying now that the stock is potentially at multi-year lows. So nothing really exciting happening right here. But you can see that even going back to 2022, these guys have been, look, they have been consistent sellers of shares. So the amount of selling greatly outweighs the amount of buying, by and large. But it's good to see that they slow down selling now that that the stock has collapsed substantially from its all-time highs. Okay, so I like to see that as well. Okay, everybody. So hopefully hopefully this helped you. I hope it did. It took me a while to put everything together for you guys, but if you find it valuable, please make sure you smash the like button and stay tuned for more, everyone. Have a lovely rest of your day, tortoises.